Thank you, Jill. Good morning. Bonjour tout le monde. Thank you for being with us today. Senior Deputy Governor Wilkins and I are glad to have the opportunity to discuss the latest issue of the Bank of Canada's Financial System Review, which we published this morning. The traditional purpose of the FSR is to identify key vulnerabilities in the financial system that can interact with and magnify economic events. And today we are facing an extreme event in the form of the COVID-19 pandemic. This FSR gives an in-depth analysis of the impact of COVID-19 on the Canadian financial system and the implications for the economy. Depuis le début de la pandémie, la Banque veille à maintenir le bon fonctionnement des marchés financiers. Comme nous l'avons mentionné dans le RPM du mois passé, l'objectif à court terme est d'aider les entreprises et les ménages canadiens à traverser cette période. L'objectif à long terme est de jeter des bases solides pour la reprise économique. Dans les deux cas, il nous faut un système financier qui fonctionne bien pour que les mesures budgétaires exceptionnelles mises en place portent leurs fruits. Today's FSR looks at the results of many of the programs the bank has implemented since the onset of the pandemic. These programs have succeeded in restoring good functioning to many key financial markets that had been showing signs of significant stress. Bid-ask spreads and yield spreads in many markets have narrowed significantly. Access to liquidity for financial institutions has greatly improved. And many of our programs to support financial markets are being used less and less as conditions stabilize. That said, considerable uncertainty remains about the future course of the pandemic and its economic consequences. The bank will continue to do what is necessary to keep core financial markets working so that credit channels remain open for households, businesses, and governments. It's important to remember that our programs and facilities, as well as the government's fiscal response, have been designed so that they can expand in line with the pandemic's impact. In addition to the bank's programs to support financial markets, we have cut our policy interest rate to its effective lower bound. These reductions, grounded in our inflation targeting framework, will help stabilize the economy and employment and lay the foundation for recovery. Emergency government programs are mitigating income losses for households and businesses. Enhanced regulatory flexibility is giving financial institutions greater freedom to continue lending as risks increase. And banks have been flexible themselves in providing payment deferrals to many customers. Today's FSR analyzes the resilience of the financial system in this unusual context. We find that the country's banking system and financial market infrastructures are strong enough to deal with the situation, and even the more severe economic scenario that we outlined in last month's NPR. The resilience of our financial system stems in part from the fact that our economy was in good shape going into this episode. The economy was operating near its capacity, inflation was at target, and banks were well capitalized with ample access to liquidity. Soyons clairs, cette pandémie est un énorme défi économique et financier. C'est peut-être le plus important de notre vie, et elle va entraîner une hausse du niveau d'endettement. Or, la bonne combinaison de politiques budgétaires, monétaires et macroprudentielles pour assurer le retour de la croissance économique et la viabilité de la dette. To be clear, the pandemic remains a massive economic and financial challenge, possibly the largest in our lifetimes, and it will leave higher levels of debt in its wake. The right combination of fiscal, monetary, and macroprudential policies can ensure a return to economic growth and debt sustainability. Further, policymakers have taken the lessons of past crises to heart and acted to strengthen the financial system. Canada's adherence to reforms after the global financial crisis, which strengthened the banking sector, is now paying off. I'm confident that a strong financial system will help Canada emerge from this episode in relatively good shape. With that, Senior Deputy Governor Wilkins and I would be happy to answer your questions.
Thank you very much, Governor. We'll now go to the questions. First of all, for reporters who are late joining the call, if you have a question, please let us know by sending an email to communications@bankofcanada.ca and I'll put you in the queue. Pour les journalistes qui souhaitent poser une question, envoyez un bref courriel à communication@banqueducanada.ca et on ajoutera votre nom à la liste. I have a list of questions already. I'm going to ask each reporter to ask one question in the first round, and if I don't state your name and affiliation, please do so. Just want to remind people to mute their line if they're not asking a question. You do that by pressing *6. You unmute by pressing *7. Avant de poser une question, veuillez vous identifier et libre à vous de poser une question dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur *6 et pour l'enlever, faites *7. First question will be from Greg Quinn, Market News. After that, I'll be going to Kim McCrail and then Shelley Hagan. Greg, please go ahead.
Good morning. I wonder if you can explain the switch from the pre-COVID economy where household debts and housing markets were seen as a significant risk to a scenario now where the economy shut down, but there doesn't seem to be a major expectation of a scenario where, say, the Toronto or Vancouver housing market could crash.
Having trouble. There we go. Sorry. These buttons are not, they're not the usual type. Okay, well, it's a good question, Greg. I mean, the fact is that when we envision typical FSRs in the past, what we're thinking through are tail risks, major events that essentially happen to the economy and their effects get magnified. And then those vulnerabilities that we've identified manifest themselves as financial stability risks. The important thing that's going on here, which is not in those typical scenarios, is that we have a truly historic fiscal response mixed in to the scenario. Excuse me. And so all those income supports and other facilities which are aimed at companies are serving to mitigate the effects of the shock that normally we would be very preoccupied with during that sort of magnification stage of a shock. And so when we do the stress test, normally in the FSR, none of those things are present. In this case, they are. And so we show you in charts, I think they're 14 and 15 or 13, 14 anyway, in the towards the latter third of the piece. Comparison of our best estimate of what the kind of counterfactual would look like. Much higher mortgage arrears, much higher defaults or loan provisions, I should say, from firms. And so the difference between those two lines is how the policies are acting to cushion the blow on the economy and therefore on the financial system at the same time.
Thank you. Next question, Kim McCrail, Wall Street Journal. Please go ahead, Kim.
Thanks. Governor, can you describe to what extent the Bank of Canada and you and other policymakers are concerned about a second wave of economic fallout after the worst of the current pandemic subsides or after the emergency programs that have been brought in are pulled back?
I'm sorry, Kim, I think I missed one very important part of your question. Could you repeat it for me, please?
Sure, sorry. I'm just wondering if you could explain to what extent you and others are concerned about a possible second wave of economic fallout, even after the worst of the current pandemic subsides or after some government emergency programs are pulled back.
Well, I mean, obviously, we really don't know about the underlying, the shock. It's what we're monitoring it like everybody else, and it's why we have not given actual forecasts in our NPR, but suggestive scenarios. I would repeat what I said not long ago, which is that I think the best case scenario or the top scenario that we put in the NPR remains within reach. that we're the critical thing is how long is the containment period. And we're seeing those early signs now of willingness to partially open up the economy. If there were to be a second wave, the one that cannot be dealt with while keeping the economy running, then we would need another scenario. I'm as concerned about that as anyone else, and it's why I think that governments are taking quite a lot of care in their approach to that opening up process. And in the background, of course, what's going on is companies are developing other safeguards for their employees and for their customers. So we are headed for a different kind of normal. And at this stage, I see no reason why we wouldn't work with the assumption that that's all gonna work and give us a reasonable return to activity over the course of the second quarter. Excuse me, the third quarter, the next quarter.
Thank you. I'm going to go to Shelley Hagan next. After that, I'm going to call on Kelsey Johnson, Dave Parkinson, Kevin Carmichael. Shelley from Bloomberg, please go ahead.
Good morning. In the FSR, you mentioned that housing market activity has decreased and that households believe that in the next 6 to 12 months, prices will fall. So I'm curious what the bank is expecting in terms of the housing market versus what Canadian households say.
So clearly households have sustained quite a change in their lives, either on the income side, although some of that's being offset by government actions, but also just in terms of the containment measures and what that means for their ability to access the housing market. And so, yes, we have seen a decline in listings, we've seen a decline in sales, as you would expect. And along with that, the price expectations have softened quite a lot, as you quite rightly note. The way we're thinking about it is just to look forward and see that once the containment measures are gradually lifted, that the housing market across the country should spring back to life. How long will that take? What's the exact timing? It's really hard to tell at this point. That's why we're working on scenarios. As we learn more about what the lifting of the containment measures looks like, we'll be able to be more precise about those scenarios. But certainly, if you kind of roll back to the end of last year and even to the beginning of this year, the housing market had very strong fundamentals, very strong underlying demand. And in fact, the discourse was the opposite. And so in the sense that people were worried in certain areas if we wouldn't see a return to some froth that had already been taken off in previous years because of changes to taxes and macroprudential policy. And so one can imagine that at least some of those fundamentals are still there, including supply issues. And so there's every reason to believe that the housing market will firm over time once the economy does.
Thank you. Next question from Kelsey Johnson at Reuters. Kelsey, please go ahead.
Thank you very much to you both for taking my question. I'm wondering, corporate bond spreads have improved, but they're still quite elevated. Is the bank considering an increase in the size of its corporate bond purchase program?
So as you know, we've committed to a certain amount that's geared towards market function, and that gearing towards market function was really meant to help corporations who need new financing for longer term plans or to roll over the existing financing they have, that they could at least access the market. If you roll back to, say, the beginning of March, remember there was hardly any activity. And what that would have meant is that those firms who employ many people across the country would have had to back up into their lines of credit, which were already at banks, which were already being used quite extensively. And so having this source of market-based financing is pretty important. At this point, the goal that we have is, uniquely related to market functioning. The question you're asking about actually trying to design a sizing of the program to change the pricing in the market is not part of our design right now. That would be something that we would consider potentially at a future date in the context of monetary policy objectives that are geared towards achieving our inflation target.
Thank you. Next question, Dave Parkinson from the Globe and Mail. Go ahead, Dave, please.
Oh, hey, thanks. Wanted to ask about the report. Obviously, talks to some degree about the risk of business failures, under sort of ongoing pressures, and talks about how the government programs provide support to a point, but it doesn't look like in the numbers that the amount that's being covered in terms of the losses that businesses are incurring is being covered to the same extent as it is for households through the CERB program, for example. So I'm wondering, if you foresee a significant number of business failures and how big a concern that is as we look out sort of 6 to 12 months in terms of the economy's ability to rebound.
Well, thanks, Dave. This is a very central phenomenon to the outlook. And it's why, if you go back to the NPR, there was such a big difference between scenario 1 and scenario 2 in the NPR. Underneath that, all there is, the main difference is a longer passage of time of containment. And that passage of time means each month you're adding more and more stress onto those companies. And so at a certain point, especially possibly companies that entered this in less good shape than was ideal, then the stress builds up very quickly. So the shorter the containment period is, the less of an issue this becomes. The reverse is the longer it is, the more it is an issue. And so in the FSR, what we've analyzed is actually the more dire of those two scenarios, okay? Because that's the FSR's territory is kind of if you like, a tail risk kind of territory. And so what it's showing is that there is quite a meaningful increase in non-performing business loans in the dire scenario, but with the policy actions that we've taken, that we and the government have taken, but a rise to like around 6% of non-performing loans. That is a pretty big rise that we're projecting in chart 15, but that is not a projection, but is consistent with, as I repeat, the dire scenario from the NPR. And we estimate in this chart 15 in the FSR that it would be far more difficult for firms without those mitigating policies that the government has put in place. So are they as perfect or as effective? It seems not quite as effective as what we're seeing on the household side, but still very effective. And then in the company sector, then what we've got is other backstop things available through BDC, EDC, and so on that are, there's access to credit channels that are not always, that as easily to tap into. And so I'm comfortable that this thing is going to work. But as again, just to respond to the essence of your question, is it all depends on how long this containment period lasts. As I said, we've got some positive signs now that we're starting to open things up, and that's going to make all the difference.
Thank you. Kevin, I'm going to call on you in a second to ask the last question in the first round. For journalists who have a question in the second round, please send an email to communications@bankofcanada.ca, and I'll put you in the queue. Pour les journalistes qui souhaitent poser une question, envoyez un courriel à communication@banqueducanada.ca, et on ajoutera votre nom à la liste. Kevin Carmichael from Financial Post, please go ahead.
Good morning. There's some suggestion that given the focus of the government rescues to business so far is so heavy on more credit, more lending, there should be a greater emphasis on equity or even grants. Do either of you have an opinion on that?
Well, at this stage, Kevin, it's hard to guess just how significant that extra run-up in debt might be. So I mean, I think it's early to have really an actual analytical comparison to offer you. I've very little doubt that indebtedness will be higher at the end of this, but I think most of the debt that's being accumulated will be government debt. And I think it's whether at a later stage we need to wrestle with that issue. Does all that debt remain as debt, or does it perhaps does it attract some sort of warrant type structure? Can it be converted into equity? All those kinds of questions may be relevant in the near term in some of the larger firms that the government is talking to, but it's really a question for the government. I'm not one to make an issue of that at this stage, because frankly, as I said, we don't know how much more debt is going to actually emerge from this.
Okay, for the second round, I'm going to go first to Kelsey, then Kevin, then Shelley, then Greg. Kelsey Johnson, Reuters, please go ahead.
Thank you very much, and thanks for taking the second round. Today's FSR had quite a bit of detail about the weakness within the energy sector, including the sector's ability to refinance potentially being tested by low oil prices. I'm wondering, how long do you see this as being a significant drag on the Canadian economy?
Yes, we shouldn't lose sight of the fact that even if we'd had no COVID-19 cases in Canada, we still would have had a negative terms of trade shock because of the global impact that we're seeing, quite a large drop in oil prices. And the situation is not unlike, if you like, there's like two shocks at the same time. So if we just set aside all the shutdown and everything and just focus on the impact of the oil price shock on the economy alone, it's not unlike what we dealt with in late 2014, early 2015. And you'll perhaps recall that we have an outstanding model that is a totem, and the reason it's called totem is because it has the terms of trade appropriately modeled in it, which is an ambitious and very quite unique in Canadian modeling. And so that model would show you that it takes often years. I don't mean during 2015, it kind of took around 3 years for most of the adjusting to that terms of trade shock to take place. Now that one was modeled as a more or less long-lasting or permanent, if you like, drop in oil prices from around $100 to around $60 or $50, something, forget the exact parameter we used, roughly cutting them in half. And this event here is harder to gauge in terms of the shock, because we believe that there's behind that two underlying disturbances. One, of course, is COVID-19, but what that did was cause a drop in prices, a drop in demand for oil. And that we believe is what led to the extra competition for market share and the lack of coordination between Russia and Saudi Arabia. So that all those things kind of come together as a package. Arguably, as things recover and prices get back to a more normal range, perhaps that will get us back quite a ways towards where we were before, but I wouldn't want to make a forecast on that today. I think the important thing is the fundamentals are very closely related to human activity, and we can see already in the short-term data signs that driving is picking up. You saw the news yesterday on U.S. oil inventories. Didn't see the continued rise that markets were expecting. In fact, there was a decline. I think the system is starting to pick up out there. And so, and here in Canada, what we've seen is Western Canada Select is actually in relatively high demand because of its unique characteristics. So as a result of that, the spread between WTI and WCS is really low right now. So all those things kind of would have to go into the mix. The real short answer to your question is it'll take quite a long time to adjust if those prices stay down that long. But right now, it's at least we're seeing glimmers that some of the pricing is being restored. And so we'll have to continue to evolve that. And I think the obvious place to do that would be in the context of the July NPR, where we'll be doing, a whole new forecast exercise. And by then, we should have some more daylight, as Ms. Wilkins said, around the outlook for the current period and, of course, where oil prices will be.
Kevin Carmichael from the Post, back to you for a second question.
Hi again. Not a great emphasis on government debt in the FSR. I wondered if you could talk a bit about the sovereign debt, and in particular the debts that the provinces will be taking on. Given that there is chatter out there that some provinces will come under considerable strain, and some people don't even rule out the possibility of a default. Given the absence of any mention of sovereign debt in the FSR, should we assume that that's not a great concern?
Well, there's plenty of things in the FSR to get you concerned, and that's obviously what the FSR usually does, makes me concerned. And of course, one of the things that does that is its preoccupation with really, really difficult scenarios, tail risks. If we look, though, at where we began all this, we began this with a very healthy economy, with unemployment at a record low, and inflation on target, and government debt, although not non-existent, was in a reasonable position. Government debt, we've got a table in the I think it's box 4 of the FSR to remind us of some of the numbers here. So total government debt in the order of 83% of Canada's GDP, but not much different from what it was 20 years ago. In fact, the federal situation at around just over 30% of GDP. A far stronger situation than what we had in the mid-90s, for instance. About half the level of federal indebtedness. And so a situation where, in particular, the federal government had a lot of room to maneuver because of, a very careful, let's say, 15-year at least, or 20-year period of fiscal policy. And so that suggests to me anyway, that the kinds of scenarios that are being painted here are not untoward. In a historical context, that there's room to maneuver there. And so, of course, also the near term, the cash needs are going to be quite high because of such things as major tax deferrals. Those, of course, deferrals would, over time, come back into the coffers. So we can't take what we see through the window right now as a permanent or long-lasting increase in fiscal deficits. So for us, we're mostly concerned about market functioning, and I think markets are functioning well right now, and they will continue to do so because we're standing ready with our programs to ensure they do. And if there are strains in the market, we'll manage them, and then over time, we can move back to a normal rhythm in the market.
Next question is going to go to Shelley Hagan. After that, I'm going to go to Greg Quinn, Jordan Press, Kim McCrail, Dave Parkinson. Shelley, please go ahead.
Thank you. What is the bank thinking about in terms of permanent business closures and what consequences this has for the longer term economy? I've heard some business associations predict there will be tens of thousands of business closures in Canada. So I'm curious what would be the implications of such a high number of shutdowns?
Well, this is the key difference again between the what I've been calling the best case scenario and the much more dire scenario. The longer passage of time during containment means that that more businesses are forced to close, and that's a form of scarring for the. There's a couple of things that are mitigants in this. I mean, what we know is that the by far the greatest pressure is being felt in sectors where business there is a high level of business turnover as a matter of course. So in the bankruptcy statistics, for example, there would always be a high percentage of the business failures will be in restaurants or other pubs and so on. That's a business which also has the shortest attachment of workers, and it's a sector which is heavily impacted, of course, by this. So we kind of have a swath there where there's likely to be a lot of the kind of damage you're referring to. The other side of that is it's also a sector where things tend to spring up fast afterwards. We don't know what restaurants will look like in the new post-pandemic world. Will they be, half as many? Like in other countries, they're going with sort of half capacity, so that there's more space between people. Does that mean we'll have fewer restaurants or more restaurants with twice as much room between tables? This is really hard stuff to figure out. But I'm obviously going down a rabbit hole here. And answer your question. So just to say, well, right now we don't know. We're hopeful that that the best case scenario we've outlined has a minimal amount of that type of scarring, and just understand that of course there will be business failures through this, and I would be expecting an environment. The platform that we're building for the recovery will be one which is very favorable to new business creation.
Thank you. Next question, Greg Quinn, Market News. Go ahead, Greg.
Good morning again. I wanted to ask about one of the bank's market stabilization programs, the one on provincial bonds. I'm wondering why a public institution like the bank is not going to publish the names of the provinces they buy debt from, and why they're not seeming to set any specific bottom line for the credit ratings of those provinces. They're public governments and the Public Bank of Canada. Why can't we have more transparency on the transactions?
Sure. Thanks, Greg. So with respect to the provincial bond purchase program, you'll find the terms and conditions on our website. They were published later last week. And as you'll note from that publication, it's quite clear that we are in fact seeking to purchase bonds from every province in Canada who are all at this point in the investment grade space. We've set a $50 billion cap on that. In the allocation formula, which isn't there, I call it a formula, but it's more like guidelines for the asset manager, are related to seeking to purchase the bonds in the proportion that they have in terms of the outstanding pool of eligible debt. Okay, and then we layer on that a consideration for their importance in terms of GDP, and that just means that we've sized it right to make sure that in each one of these provincial markets, we're doing enough to improve market functioning, which is in fact what we're seeing. On a weekly basis, we'll have the amounts that we've purchased. You will see probably in our weekly statistics last week, we had some 120 million. I might not have that number exactly right. And so the combination of that provides quite a lot of transparency.
Thank you. Next question, we're going to Jordan Press from Canadian Press. Jordan, please go ahead.
Oh, hi, good morning. I was hoping that maybe you could just walk me through a little bit about what you see as the right combination of policies to help households when we get past this crisis, to help them manage what will be a higher debt level.
Well, I'm actually, we could just debate for a minute the premise. I'm sure there will be households with higher debt levels after this, but our reading on the early statistics suggests there will also be a lot of households with lower debt levels. It depends very much on the circumstances. And we've got a good analysis in Table 1 of the FSR. By the way, in a similar track, a good analysis in Dave Parkinson's column this morning in the Globe, which suggests that the policies the government has developed are so highly targeted at the most affected individuals that actually they're doing quite a credible job of offsetting the income loss related to the shutdown. I can't say that that's true for every individual, but on a sort of on an average basis, or the median individual in that set, they were well designed for their purpose. I've said before that they're in a stabilization sense, they're just what the doctor would order, which is to say they are elastic. If there are more people that are affected, there will be more money. You don't have a program that's priced at this much, and then you have to go get reapproval to start again because it's not big enough. It's elastic. It will expand or contract depending on the conditions underneath. And so that suggests that for that important segment, the most affected, there should not be a meaningful increase in debt there. And for another swath up at the top where they've continued to work from home, continue to get paid, and have had fewer opportunities to actually spend on things. According to the banks, what we're seeing is people are actually been not using their credit cards as much as before, and they're actually paying down net. Therefore, they're paying down their debt. So I think there's an ambiguity there about where we're going to end up. That's all I really want to say. And so I don't want to prejudge the situation here. And what do we need for the recovery? Well, we need, first of all, the economy to be opened up again. That's really important. So we're starting to get the first parts of that. And secondly, we need that these programs I've just described have buttressed people to the mix. And so putting a floor under the economy like that should mean we have all the ingredients for a very robust return to economic growth in the second half of this year. I'm not arguing we'll get all the way back to where we were right away. That will take some time because there is going to be some damage. But I think a large share of what we're seeing should go away relatively quickly.
Going to go next to Kim McCrail from the Wall Street Journal. Kim, go ahead.
Hi, thanks. I just wanted to return to the analysis in the report that found that policy measures like wage subsidies and mortgage deferrals and some of what you were just speaking about had a big impact on seem to be having a big impact and maybe will have a big impact on reducing mortgage arrears and non-performing business loans. And I'm wondering if there's a risk in your view that some of those policies might either run out or be phased out before economic activity has completely recovered. And if so, how concerned might you be about a big rise in some of those risky scenarios further down the road?
Well, I'll start and then I'll see if Carolyn would like to add anything. But I I think primarily that's a question for the finance minister. But as I said, the ones that are doing the lion's share of the work were designed elastically, and yes, they have an horizon built into them. They were based on our perceptions at the beginning that this would be, we know what pandemic curves look like, so that by around now, we would be starting to reopen businesses, and we are. So that was the basis for our best case scenario. So, I mean, that if there's a residual concern about programs running out too soon, I think that is something that we would need to refer that question to the finance minister. Carolyn, did you want to add anything to that?
The thing that I would draw your attention to is just really what was the underlying purpose of those scenarios, and it was just to see how would the banks perform in terms of their own ability to keep up their liquidity buffers and their capital buffers. And so what we found was that, in fact, they still had in terms of capital, well over the minimum amounts and well over those amounts that included what's left of the domestic stability buffer. And to me, that's not only very positive news for today, but it's a real lesson for that policy mix question that was asked earlier, which is we're glad, I think, that we made the choices we made in terms of financial reform, Basel III, among other things, and we're also glad that the macroprudential tools were put in place when they were, because that's what puts those banks in the situation to be able to withstand what's going on right now. And at the end of the day, that means that as much as possible, they can be there for businesses and households.
And we're down to our last question, and it'll go to Dave Parkinson from the Globe and Mail. Dave, go ahead, please.
Oh, sorry, that came on me a little too quick to get my unmute. Yeah, I just wanted to ask, one of the perceptions out there that's been pretty persistent is that the government's the bank's government bond program is essentially financing the increase in government spending that's been forced on the federal government anyway over this crisis, like I said, I mean, we're buying up these assets on a daily basis at roughly the pace that the government is issuing new debt on a weekly basis. So I'm just wondering if there's any concern about this, about the perception of the coordination that appears to have been going on here, compromising in any way the independence of the central bank and the separation of central bank policy from fiscal policy.
Well, thanks, Dave. Well, I can say that this government has been unwavering in its commitment to central bank independence throughout this, and we have behaved in ways which are completely consistent with our inflation target. And the key anchor to all that is the inflation target. And so under that, the old adage is that central banks have the power to lend, governments have the power to spend. And that distinction is crucial. And for us, the business of lending really only has its power when people have confidence in the inflation target and therefore the independence of the central bank. So all those things all go together, and for us, then you have to see what we're doing in that context and ask, well, what's the objective? If the objective is, in the first instance, market functioning, that's crucial because the monetary policy actions we've taken won't go anywhere if financial markets were to stay kind of gummed up as they were in early March. Ensuring that market function through what we know will be more strains before it's over is crucial to all that transmission and to make sure we've got a great platform for recovery. And afterwards, as things return to normal, whether it's gradual or rapid, you will see our activities go back to normal, but that depends on the monetary policy context that we find ourselves in. Carolyn, would you like to add anything?
I'm going to say that was a perfect answer. And I'm going to take the opportunity to say that was your last perfect answer. And I wanted to say a few words about Governor Poloz because this is his last press conference. What can I say? He's dedicated the last 7 years to the Bank of Canada and to the well-being of Canada. I know my colleagues are behind me when I thank him for what he's done for the bank. We are more dynamic, we're more engaged than we were 7 years ago. And we're going to miss him. The spaghetti sauce, the rabbit holes and the firefighters and all of that as well. So with that, I just wish you all the best. It's not probably the last time I'll do that, but I'll do that in front of everybody. I wish you all the best, health and happiness to your family, and say that we're all also, really looking forward to welcoming Tiff Macklin back to the bank. So thank you, Governor.
Thank you very much, Carolyn. That's very thoughtful, and I couldn't have done it without you. Thanks.
And with that, we'll conclude today's press conference. Thank you, Governor and Senior Deputy Governor, and thank you all for joining us.